Hey everybody, it's Pete Carmasino here. Hey, I'm just checking in again today, just looking at some things here. I saw a trigger that I follow. It's basically an indicator that's two ETFs put together, kind of a ratio chart that we talked about in the last couple of videos. It's QQQ, the NASDAQ 100, over the consumer staple ETF symbol XLP. And when this starts to move to the downside, it obviously is sort of a signal more than it is anything else. It's not really a call to action, not yet anyway. But in the past, when this has happened, we've seen obviously some market movement to the downside. And all this is telling you that just in the other videos, we were talking about offense versus defense. This is specifically looking at them directly in competition with one another. And when you start to see the XLP start to move higher than the QQQ, again, in this ratio, or the QQQ turning down based on the ratios, mathematical equation, you start to see signals that we might be getting a deeper pullback than we might anticipate. Now, it's not there yet. I'm going to show you right now. That's what this video is for. So continue to watch. I'll show you how to look for this and how you can create it on your own. All right, I'll zoom out as far as I can here to kind of so you can get a closer look at what's going on here. A couple of things. This is an upward wedge. I'm not, a CM, certified or chartered market technician. My point is that the technical analysis is something that I've been doing for quite some time, over 30 years. But looking at this pattern, we see a lower high. It starts to concern you. I don't want to see this break. This, to me, would be support somewhere around what this, this ratio equals about 7.5. When it gets around that level, in this scenario right here, we might be breaking the recent low. And that would tell you that the QQQ is definitely getting weaker and potentially XLP might be getting stronger. And that's really what this is. It's a rotation from, risk on to risk off, or offense to defense, however you want to say it. And that's what's happening here. Now, I look at a lot of different things. I've got multiple moving averages here. I've got a short-term 10, a 20, a 50. These are all simple moving averages, except for the 10 and 20. And then I got a longer term simple, which is 150. Now, I like to look at the slope of that. If that slope starts to move lower, we've got a different problem on our hands. That's definitely a regime change and potentially a trend change in the overall market. We don't see that. We're actually up at the highest I've seen this since 2017. Now, I could squeeze this chart and scroll all the way back and look at some other scenarios when this exact same pattern developed and obviously turned into a downtrend. You can see it right here. And I have the S&P in the middle panel. You can see right here at around, January 23rd of this year, we peaked, then tried to move higher, but it started to break down almost exactly on the day that the S&P topped out on February 20th, and it started to move lower. Now, you can see that 150. Once we breach that, it really is a lower trend situation. Now, this was only short-lived. We knew, this is from Liberation Day and tariff announcements. Again, you don't know if it's going to be a short-lived situation or not. You have to wait, and you kind of have to look at, again, reading the tea leaves, so to speak, of the market. Now, I could scroll back and even look at last year in 2024. This is in July where we topped out. You can see where the ratio, the slope of the 150-day moving average of the ratio started to kind of trail down pretty dramatically on a daily basis. And again, that's a 5-day look at that slope. What am I looking at here? I'm looking at a potential pullback. And then what did we have? We had some news. We had the Japan carry trade was being unwound. That, again, was a short-lived situation. Started to move higher. Once the slope changed, we were in better shape. And that didn't happen really till October. But you can use these shorter-term averages. When they start to cross, you can sort of scale back in to riskier positions when that happens. Again, not a perfect signal by any means. I don't know if there is one out there that exists. But to me, it's a shot over the bow for technology, and certainly a warning signal for the risk on appetite. And it's certainly legitimate. You can see the obvious trends. Here's where the bear market ended, January 11th, roughly, when these two areas crossed. Again, these are the shorter term exponential moving averages, the 10 over the 20. Not very traditional type moving averages. I know a lot of people use different numbers, on lower time frames. But this was a really nice signal to start to enter back in. There was a lot of other signals as well, like bonds and things of that nature, interest rates, a lot of opportunity to be, and a lot of signs telling you that bear market was over. But this one's concerning me. This is almost the identical pattern that we're seeing here. This is the beginning of the 2022 bear, and that's where it started again. And look at where that slope starts to turn negative. That's really the confirmation that this particular ratio is kind of validating. So look, I'm not saying that this is an all-out bear market or anything of that nature. What I am saying is that the signal's there. It's appropriate, certainly legitimate. It's certainly risk versus defense, and it's right here for you to use if you so choose. I thought I'd bring it to your attention. I am concerned about it. Certainly, would rather be an optimist and wrong here than a pessimist and right. But we will just have to let it play out and see where it takes us. All right. Thanks again. Until next time, I'm Pete Carmasino.